All right. Good morning, guys. Ken at Tortoise Capital. This is the Foundations Q&A session for the Eurozone. It is April 18th, 2021. So we got some housekeeping to do and some clarity from last night, which will continue. So, Matthew, I notice you're in here. You'd asked me about the Phoenix, the so-called Phoenix trade. That was a spontaneous name, which I really like. On ETHE on 414, and wanted to take specifically a look at the potential stop around 1030, and then like a re-entry for wk2. So that's a good question to illustrate a couple points. So I went back into my trading log in there and then sorted by date. So 414, there's my flashcard Phoenix trade. So easily recalled. Let me expand this. So for context, what had happened was the day before, ETHE, I believe, had made a really nice move and then closed in this sideways channel right near the VWAP. Then in the morning, there was a really strong gap up, which could not hold. Let's see. Yeah, there was a big, strong gap up. And then it could not hold. I want you to remember this one, recognize this one as a pocket. Is Denny on here? Yeah. Denny, you asked me about the difference between the lazy W, the pocket, and a wk2. So they're very closely related. The pocket is specifically this, what I'm calling this little price zone inside here, regardless of any previous price action, whatever. But the feature is that the dragon is rolling over, and then there is some price level that indicates that it's breaking out of this, like out of this box, and any price below this line. Let me make that a red line. Any price below that red line is going to be a clear indication, in this case, of a return back to yesterday's close and the fair value and the Bollinger Band mean and the VWAP. So there's some virtuous target area down here we want to get to, and the non-controversial price where that starts would be this breakdown here. And so when the dragon in this case makes that turn, there's this little zone of hesitation in here, and I'm calling that the pocket, right? When we look later at like a lazy W, you'll notice that there's you would see like a pocket in here and a pocket in here if you zoomed in, and this whole thing is gonna, we could call that whole thing a lazy W. And then there is a specific implementation of that in what I'm calling wk2, and that's really to reinforce the behavioral aspect of trading a pattern in the form of a kata, a repetitive mechanical drill that happens to be an implementation of a lazy W. And so the overlap between wk2 and lazy W is probably 95%. There may be a hair's bit of difference about them. To me, the difference is in the behavioral actions that is triggered for me by the idea of a kata as opposed to a description of a particular condition. And then, so those two are very strongly related, but the pocket is more of a narrowly focused idea for me on a particular price action inside of a larger action where there's a zone of hesitation at a point of transition, and I'm trying to decide if I want to make an entry in here to front run a move that I really want to take. Like I really want to be short when that thing gets through here, because the dragon will have reversed. In this case, it will have made a new low of the day. It will have crossed the Bollinger Band mean in the same way that I want to really get short here when it breaks through the river, and I want to get short here when it leaves the Z2 and when it crosses the RL270 and when it breaks below the Z3 pinch. So there's there's many confirming signals that are happening here that sort of document that this thing is crashing. And here's another almost hesitation that if I looked in closely enough, maybe I could force myself to see another pocket in here, because it was hesitating and then collapsed again below yesterday's close. So it's at this price level, I'm already getting confirmation that yesterday's psychology allowed people to hold this at this price level overnight, hoping to see this kind of upward move. But then when it breaks through that price level, then, oh my goodness, there's a whole nother series of cascading reasons why it should fail. So for me, the pocket is part of that interpretation of a transition and a turning point. And it's bounded by some previous, in this case, a support level, which, if broken, feels significant to me. So you end up using a pocket. You see pockets when you see lazy W's, and there's certainly a pocket that can be seen inside kata 2. So in that sense, it's more of a subordinate concept, I suppose. But then the relationship between lazy W and kata 2 is like 95% overlap. But for me, the difference in naming it is because of the implications of the name kata, because it's a whole package about where I want to enter, what I have to see, where I want to enter, where I draw my initial risk box, and so forth. Let me know if that's clear enough. So I wanted to say all that anyway, because that pattern that we're about ready to look at now, we're really going to look at this. I think Matthew asked me about, well, why not exit there? But probably should have. But I wanted to talk about the things that were influencing the decision not to get in, because I remember that moment. And one of the amazing parts of that trade was this context here of this. What had been the best mover of the day before, what had been the largest gap up, and then the biggest collapse down in a short period of time. So this was really, blowing off steam. But then it held support over right where it's supposed to at the previous VWAP. And so it made this stop. And I get long in the usual way, because I had traded this one on the way down. At this moment, the RL90s rolling over, the Z3s are pinching, and in my mind, I was using the Z3 box as the controlling frame, or the range of normal here. And I see the VWAP is now up here that it wants to get to. And ETHE was the first thing in my stack to reverse and start going up after just about everything had this great big sell-off and ETHE found support first and was the first to make a move up, and so this felt like I was getting close to the cut point, and then when it didn't fail, I was ready to buy this Z3 breakout to the upside. Now, what I would say, absent the previous context, which is all the endorphins probably of making a really nice trade. Because this was an exit in here off a really nice swing trade, and then a short trade that got two big scoops, and then this thing was behaving beautifully and turning around that way. And my spider sense was that if anything in my stack of trades was going to work well, this was going to be the one. And as long as it didn't violate the Z3s, I was okay with it. Especially given that first burst out of here was so strong. You see that happens when that first move is up and strong, and the PSAR has already gotten above the Bollinger Band mean, and the whole river has turned. And so, what I would say is a perfectly acceptable and reasonable and prudent stop would have been in here, like at the Bollinger Band mean, so you could actually make bank. You could have cashed this region right here, so that would have been a plus against a risk box of about like that. So you'd have gotten about one execution R, and then either that Z3 breakout would have been fine, or you might have re-entered quickly here. If I re-enter here, then I'm not going to take that, because that's two entries that are too close to each other. I would be looking to make a second. So if this was my first, I would be looking to make a second entry here as it crosses the VWAP. But your question was specifically, why not here and then re-entry? That's the way to do it, I think. The only reason I didn't at the time was because of the magnitude and the sell-off here, and the fact that it was holding and it was the first thing moving. So, and I was using the Z3s, that Z3 box here, as the controlling frame. Let me know if that makes sense. I would, if I'm coaching you to do it, I would say, hey, I would rather see you take that one and then re-enter, because to me the key to this style of trading is the idea that re-entry is the key to sanity, and I like to have standard rules to exit and then standard rules to re-enter in the form of a kata, that behavioral failure to fail further and resuming the trade. That's resuming the follow through, and so that feels like the correct battle drill. And all I can say is the reason I didn't do it at the time was because of previous list of reasons: the magnitude of the move, the strength of the turnaround, the timing of the turnaround compared to other things that I was watching that were also in a transition. Like the other cryptos were just starting to turn around, right, while this thing had already made one move up and was getting ready to go again. So for me, that Z3 boundary was kind of the key to the next leg up. And that was such an interesting moment that it made me think of the phoenix rising from out of the ashes of this collapse and a strong upward move, and that's why it kind of felt like that. Okay, so that's my answer. Excuse me. Okay. Denny asks. Let me see the answer. Yeah, it's yeah, Matthew makes a point that that's probably strongly connected to the 2R battle drill. Yeah, it really is. Because in that kind of transition with that 2R battle drill, um, you had some reason to get in, and the thing moves up, and then there's some price level up here. Uh, we could call that the 2R that you were hoping to see at the moment of entry. Later on, you're going to recognize that to really be any price level that you could reasonably expect some resistance. Like it has moved up to a previous resistance, whether that was 2R or not, and now it's starting to. You have to make a decision here that, hey, if this thing starts to fail, how far am I going to let it fail before I get out? And then if I do get out in order to preserve this move, and then it starts to reverse, how am I going to re-enter? Am I going to re-enter here? Am I going to re-enter here? Am I going to find the peak of the price in here and re-enter there? So where is my re-entry? And then on this one, if this is here, is this also a short position because I'm looking to get back to the previous critical state? That should be purple. Sorry. So and then if this thing does hesitate and I haven't gotten out at a place where I was going to get out and it starts to reverse, where on this move am I going to wait to add a second position here? Or if I'm going to add a second position, do I add it here? Do I add it at this breakout? Do I add it when it breaks out above this previous one? That would be a pocket in my mind. So the 2R battle drill asks you to treat this whole transitional state as the routine decision making that you do after you started from a critical state and you observe the next reasonable, oh, there's two units of reward against my 1 unit of risk. And so if it got to here, I'd be happier than a dead pig in the sun. And now, as it's coming up to the place that I forecasted as a reasonable resistance level and therefore a price target level, and it starts behaving in the way that I hoped that it would, or expected that it would, or that I visualized that it would when I saw this as resistance, I've got to be able to turn that whole thing into the most routine set of decision criteria of all, right? Because that's what I hoped would actually happen. So if I get to see what I had hoped would happen, then I should have rendered that into the least painful decision and the most rehearsed decision that I can. And so that was sort of the genesis of the 2R battle drill, and to ask all of those questions and have that sorted out in my head at the moment of entry. Like this whole decision, the 2R battle drill, is built into the trade framing so that when I'm taking this, I've already rehearsed and reviewed what that decision is going to look like at each of the resistance levels on the way up the ladder. Then I don't know where that resistance is going to occur somewhere, but it's going to happen somewhere up that ladder. So as I get my little moment of entry and this thing starts going up and it doesn't come back enough to trigger my exit, then I can just be locking in these little pieces as I go, and each next level of resistance becomes the next implementation of the 2R battle drill. So I want to get good at those decisions and make that simple so that it doesn't cost me a lot of time and effort and emotional anxiety, and sapping my will to trade. I want to make that as routine a set of decisions as I can. So I have, if I made 10 decisions in there, maybe the first one was the moment of entry, and maybe the last one was the exit that I took that terminated the trade. Like I'm not going to stop and reverse and maybe whatever. So all of the intermediate decisions were all a form of 2R battle drill where I'm measuring the reward to risk, assessing that as it goes up the stack, and doing a standard set of adjustments to the trade management process. One of the beauties of the Wu exit is that idea that once you see the PSARs move enough, when you see it three bars above the entry, 1, 2, 3. If I'm using the Wu exit, then that initial exit was probably drawn down around the PSAR. Now I can move this up, keep that in place until the Bollinger Band mean picks up, and then the Bollinger Band mean becomes the way of routinely managing that exit on the way up. So I have zero cognitive effort about how and where and when, because I've just committed to that particular exit strategy. So now I can just apply that battle drill, apply that kata, if you will. And now I can make all of these decisions routinely, and then that preserves my emotional willpower. There's other versions you can do, like Bill Scheidt and Jeff Boccaccio are looking at on 2-minute charts. They have a couple thousand case studies in their back test on supported spring crossing and kata 2, and says, what if I just use the PSAR and track that? And they're pretty satisfied with that on 2-minute charts. And I think there's good reasons to look at that. What I have found is that the tighter that I end up being able to draw that initial critical state and risk box, it's more usual to see this thing wiggling around in here before it finally takes off. And so the Wu exit was a way just to say, in the formative years, let me just give it this extra piece of time and space to give it a chance to, because otherwise a lot of times it would trigger and then hit a re-entry. So I just said, let me just put a time box on that and say, wait for the PSAR to have gotten above my moment of entry, 1, 2, 3. By that time, it feels like the whole trade has moved that way. Now I can reasonably just get my risk out of there and then just apply a standard management rule on the way up. So the Wu was my method of giving it enough time early in the trade to prevent me from having to watch it closely. Because if I'm trying to manage, 4 positions at once and I can put the Wu on them, I'm not micromanaging each entry. But on its merits, there's a lot of reasons why that just tracking the PSAR as the working stop, there's a lot of goodness in that. On the higher time frames, if you should take a look at the weekly charts, and what you'll see for really good long-term trends on weeklies, that you'll see that the PSAR looks like that. It'll just keep cruising, and the dragon will, because of math, the way it's computed, the dragon will often look like that, and there'll be like 2 parallel lines. And the southern skin of the dragon, let me draw that in black so it stands out. That southern skin of the dragon is a very good exit, because you'll have price monkeying around over here, and sometimes you'll get some penetrations down in here. And then an exit, if this thing were to go through, you'd be happy with that as an exit on a weekly bar, and then the PSAR gives it a little more room, but stays in a little bit longer on trends that really go to the moon. Go take a look at in the year 2020 the phenomenon of PBW, and you'll see that that was just an amazing. Either one of these was great. The Dragon was really good. The PSAR was really good. Kept you into a really good trade. So that's what I wanted to say about that. Let's see. Yeah, yeah, the Jackson Pollock approach of it looks like a dog's breakfast by the time I get done drawing it. And at the end of it, I look back and say, what in the world was I trying to say? I've been studying this idea of like impressionistic paintings and storytelling and storyboarding dynamically, and the visual drawing in conjunction with the spoken word combines both that visual and auditory channels. But it's really more of a performative learning. It's like, hand gestures, only now it's sketches on the wall, and gives it a certain dynamic quality. So when you're like using whiteboards or making sense of things and you're building the story out, that at first it's here and then I went over to there and then it was like this and then it came back here, in the telling of it, those graphics can help with the explanation when you get to the end of that thing, and then all of this stuff is all garbled up in here. It's not obvious how to unpack that. And so a lot of times when I find myself making the same sketch and storyboard, a lot of times I'll try to clean that up and turn it into something like a PowerPoint mind map that's very clean. But what I've noticed is in hundreds of examples of teaching with these visuals, that there is a certain dynamic quality that helps the learning through the live storyboarding, and that some of that dynamism is lost in the PowerPoint. But what the PowerPoint does give you is sort of that static template that lets you, check the blocks and remember all of the important components and pieces and things that are in there. And then if you start with this and then go to there and then try this and then finish up with that, that PowerPoint can be a nice clean way. So a lot of the charts and stuff that you see started off as standard drawings and storytelling, which then got rendered into PowerPoints. So one of the things that you'll get out of marking up your own charts and talking through with words what it is you're trying to see, or what it is you see and what you're trying to say and what it means, if you try that as a way of performing your knowledge, it will really strengthen your convictions and your beliefs in this body of knowledge that you're assembling, right? As you start telling those stories and putting in here, that self-talk becomes a professional body of knowledge, or a PBOK, that gives you a feeling of confidence and a justification for confidence. So when you go out into the world and you start trading that, and you're calling on these little pieces of your professional body of knowledge, it helps you make the decisions because the cognitive cost is low, because you're going to the tool room and bringing in something that really helps you. So there is an accelerated learning curve that goes along with, the spoken word, the drawn image, the narrative that pulls things together to make sense, and then maybe the final product that becomes a template in your battle book, in your toolkit. So that's worth trying. So Catherine Crucial, who worked with us for years on this, is she an engineering mind, a procedural mind. And she would go through her learning journal, and then she started trying to do that kind of impressionistic painting. Her first 50 golden nuggets, where she was drawing sketches, and it reminded me very much of Beatrice Potter in that style of, nice soft colors and shapes and live living creatures, and it really helped her with that side of her brain. And she sort of had the engineering side of her brain and then the intuitive artistic side, and the sketching allowed her really to bring those two parts together and really helped her trading. So you might give that a try sometime. It doesn't cost anything. I'm finding this 3D paint with a little sketch pad from XP Pen is the company that does that, and it cost about maybe $35 for a 4x6-inch drawing tablet. And then once you get over not having to watch your hand draw on the tablet, but you can feel how your hand moves as changing the cursor move around, in a couple hours you'll develop far better proficiency than my primitive sketches. All right. So anyway, that's what I wanted to say about that. Yeah, if you think back to the Matthew made a point about the river metaphor. That was like a storyboard that jumped into my head visually, and then the words just naturally followed, and then documenting it in that story was to sort of lock it in, and then that led to that, what I think is a very clean and concise graphic on the pinch and stretch, and then the idea of moving rapidly between critical states. You have some critical state where the Z3 line's pinched, and that thing bursts down here and then comes into the station to the next one. And so you get this series of, sharp moves, and it almost forms like a network of price action, where price is moving very quickly between the stations in those explosive breakouts from a pocket, let's say. But then you get this very tight, almost 2-hour battle drill kind of thing, where things start to compress into the next breakout. So you get these two characteristic types of movement. You still see all the little waveforms and the little patterns and everything forming, but the amplitude, the size of the breakouts are significantly different. So there's a characteristic movement in here, and then there's characteristic movement in these consolidation zones. And it almost feels to me like, when you're driving in Germany, what it's like driving in a German village or a city in the Stadt, what that's like, and then what it's like on the Autobahn. And so in one sense, this idea of the pocket is that we're in the Stadt. And so the pocket entry, once this thing starts turning and starts going, like especially when the RL10, which parallels the dragon usually, and then makes a regression line crossover, then comes up through here, the slower moving dragon gives us some confidence that we could use the lower skin of the dragon as the execution risk, knowing that if it fails, that next move down is going to be massive. And then when we look back, the other turning point in the dragon was here. So if it breaks out of this, then that's going to be an emerging dragon. The dragon is emerging from the Stadt. Now you'd also see the river in there somewhere too. But when we're isolating on the pocket, the idea is that in this little area of hesitation, like a coiled spring, this thing is compressed, and then if it breaks out, it's going to be big that way, or if it breaks down that way, it's going to be big that way. And so I'm actually buying in the hesitation, and then the crossing the RL10 crossing over the dragon gives me just enough confidence to be able to draw a nice tight little execution risk box here. And then that might be 2 execution risks to the real test of the breakout here. And then if that thing goes, then that will feel like leg 1, leg 2, and leg 3. And so that might be leg 1 of the next the next higher time frame, which could be then leg 2 and leg 3 if everything comes together for us. And then out of this tiny little critical state, you end up getting some measured move, and then each and every one of those resistance levels on the way up becomes an area in which we can invoke the 2R battle drill to keep our sanity. So we can make a lot of decisions in here at low cognitive cost. And if we can render that into a personal kata, then we can be trading standard plays without having to go through a existential crisis every time we're going to make a decision on how we manage the trade on the way up. So you get some entry trade, then some number of standard decisions on the way up that triggers how are you just going to follow the PSAR stop up? Are you going to ratchet it up? Or if it makes a big burst, you're going to use the PSAR stop and then it has some favorable move. And just for now, I'm going to ratchet it up and lock it in until the regular PSAR or the Bollinger Band mean picks it up. So I think of that in many cases like a mountain climber, especially the further up the mountain I go. And if I got one entry in here and now maybe a second entry here and a third entry, now suddenly the wins and losses of all these little wiggle retracements are large. And if I've got a large position on that was earned by climbing the mountain, maybe I don't want to give back everything all the way to the manager. And so that might cause me to start ratcheting in more and more pieces of the bigger win, so that if I'm able to get 4 positions in, and then that's the only thing that I'm managing, I've got a very carefully managed stop, because now what used to have been just a 0.25 retracement is a give back of a full R, because I've got 4 positions on it. And so so in the early stages, maybe just the PSAR is good enough. And then if it gets past here, maybe I go to the Bollinger Band mean, or maybe the southern skin of the dragon, or whatever I'm doing to place these little wedges in. And you've got to work out that timing model to suit your own psychology, so that however you perform that, you can learn from it and you can be satisfied with the rules that you evolve that work for you. And so if I give you something like 20% of this whole system is the idea for the basic frame and the critical state and some of the ideas on how to manage it, and 80% of it is you making the adjustments that make it repeatable and standardized for you. So maybe 80% of it was the initial system and a pretty good exit strategy, like just use the PSAR or just use the Wu Wei. And then you're relying on that system for the initial 80%. And then as you start fine tuning the exits with the 20%, you get a total, your total 100% system is the basic template plus some pieces and parts that you can use to refine it for your strategy. And then as you go, that you'll end up spending the next 80% of your time on really refining the exits based on how it feels and fits you in your style of trading and your preferred time frame on your preferred targets. And then the basic pattern diminishes to about 20%. Hey, the initial setup and the entry level is really only about 20% of this thing in terms of cognitive complexity. And then that you spend about 80% of your time because you're making multiple decisions on the way up, and that's where you end up spending most of your time in managing the trade. So there's some little interesting conundrums in here about the 20-80 rule and the 80-20 rule, about as you go through time, where are you spending the 80 and the 20 and all that stuff, maybe learning the initial pattern and the entry and a good enough start point, then adjusting the stops. And then you just use that standard entry is good enough. And then you spend your real time learning to manage and learn on the adaptation of the exits. Okay. So that's what I wanted to say about that. Hey, Denny, I need to know if I answered that next question sufficiently for you on the difference between Kata 2, Lazy W, and Pocket Entry. Was that enough? Yeah, Garen, I saw your question too. I will add that to the right board, and I'll get to that before we get out of here. So for Denny, I think I've answered beaten that to death about the Kata 2 versus Lazy W and Pocket. And then, I would just also say Glossary 3, version 3, those are the accumulation of, definitions as we go through time. And so, dictionaries and glossaries evolve. The idea of the PSAR flip box is relatively new to our language. So when we had a nice strong move up, and then the PSAR was going up with it, and then that thing rolled over, at some moment, the PSAR flips over. So what we're thinking of is the PSAR flip box is if you took the last PSAR dot in that row, and then when the RL10 rolled over and that triggered, and that caused the new PSAR to come up in here, that this space between those two, that really looks like the indecision zone. That's how much room the PSAR is giving this transitional state to say, it moved far enough now to flip. This thing rolled far enough to flip and say now that for the working trend is downward with a stop, drawn at the PSAR, that now gives you that much of a risk box, execution risk box on the way down. And so this idea of watching how the PSARs roll up, and then the PSARs roll down, and then the PSARs flip and roll back up, it kind of created in our mind this idea that this was really, the magnitude of the indecision zone, or the yellow zone, if you want to draw it in blue, so you can see. But that's really where that execution risk is drawn. And then when you look at your preferred targets long enough, you start realizing, hey, what is the magnitude of these typical moves? The length, and then what was the height of it? How much did it gain during that PSAR trend? And what's the size of the typical reward versus the typical risk? And is that kind of creating that favorable 2-to-1 reward to risk? Another way to look at this is the what are those boxes? Drawing a blank. There's a style of charting which makes new boxes based on a defined. So you could make a new box when price makes a new ATR gain, it then starts, it draws the box. Why can't I remember the name of that chart? Because I'm 63 and tired. But that will give you an image of what are the typical sizes of, in this case, how many ATRs does it typically move before it reverses a full ATR when it now starts showing that as a red box? Why can't I think of the name of that chart? It's a standard chart, but what that will do is it kind of gives you the same feel. The PSAR is geared towards time, but this other chart system where you're using just, and you can make that, you could make it dollars, like make a new box every $2, or make it every ATR so that it becomes adaptive. That's the one I like, because on swing trades, I'm using multiples of ATR for the trailing stop. And I'd like to know what the size of those typical continuous trends are. And then if I see something that's always like 6, then I could give it 2, knowing that I have 4, and there's my 2 to 1. I will. I'll interrupt the broadcast as soon as I remember as soon as the name of that chart pattern jumps in my head. Ridiculous. Yeah, Renko. Thank you. I couldn't think of the name of that to save my life. The Renko chart. Thanks, G. So the Renko is a very nice way. It's similar to the idea of that point and figure chart too, but I really like the Renko because it, especially if you're using ATRs as your method for standard risk taking, when you can express the size of the trend in terms of ATR movements, chained ATRs, that gives you at a glance a way to judge whether or not that target is suited for that style of trading. So take a look at the Renko for those of you interested in swing trading. And you can actually do that, for like 30-minute charts, 1-hour charts, 2-hour chart. If you're on that kind of time frame, only instead of a full ATR, you might just make it, hey, let me see a 0.5 ATR. On intraday stuff, I like using 0.25 ATR. Yes, you can also take the frog box or a fraction of the frog box for that day and tune your Renko box into some multiple of your minimum manageable risk box. Snap. That's a really big idea, by the way, because what it does is it delinks it from time, and it says the only thing that really matters is the directionality that traders make for price in certain measured bricks. And I don't care how long it takes them to make that decision, but I want to see that there is some persistence in the directionality, which is what a trend is persistence and directionality without a measurable pullback, that significant pullback. And then that's sort of how you can define, at the end state of that trend, it then moved back one of those boxes or 2 of those boxes, and now you can study the trend that way. All right, Denny, I'm going to assume that I answered your question on the other one. If you need more on that, just let me know. Okay, now this one is really good too. It's the speaking to the difference in the construction purpose and interpretation of the Red River on the MACD, especially in comparison to the to that Blue River up top. Yeah. I tried to do that in words, and let me draw the picture. So the price charts that we use, on that screen, and now this is if you don't have the TC2000 where we've transposed the color of the season onto the RL10 itself, but So where price is happening up in here, we're using that RLCO, Bollinger Band Mean Framework. We're watching price move up and down. Oops, where'd my drawing go? Try it again. So we're using on the top level the price, and we're using RLCO, and we're watching the Z3 lines converge and then expand as it trends, and then it comes in and converges again. So we're watching that expansion and contraction, and we're watching to see how price is moving, and then we are simplifying that price with moving regression lines, and then we've got a dragon that's floating around in here, and we've got a thick river that's in there. So that can be a very cluttered space when things get into consolidation zones. So one of the most important relationships in there is the relationship between the river, and I'm going to draw it as a turning point too, is you got a river and the centerpiece of that Bollinger Band mean that's right in the middle, and then you get some Z3 lines way out here. And then you have the Z2 lines is the floodplain. So we've got Z3, Z2, Z1, 0, +1, +2, +3. You got that Z-scored ladder, if you will. And this Bollinger Band mean is a simple moving average 30, which defines, the broad trend. And it's slow and ponderous. And because of math, 2/3 of the price data is contained inside the river, between Z +1 and Z -1. When you go back 30 days, 2/3 of all the price data is contained between Z +1 and Z -1. Now, the dragon we use, in a strong directional trend, that dragon is going to come out here and move along really with the edge of the river normally. It would be rare for it to get out of the river that much, and when it reverses, it's not unusual to see that swim to the far side of the river, and then the whole process is going up. And so the dragon gives us, we really like to watch, hey, where is the turning point at the belly of that dragon? Because that quite often will work as a reasonable boundary for that upward move. And so any price that were to violate that would be an indication that we're really going back to the trend that caused the dragon to go down, because it made a new statistically significant low as measured by the dragon. So the inside, the spine of that dragon, the very midpoint of him, well, the dragon is a Bollinger Band 10 period look back plus or minus 0.5, whereas the midpoint of the river is a Bollinger Band 30, the river is plus or minus 1. So the center point of the river is a 30 period simple moving average. The center point of the dragon is a 10 period moving average. So there is a fast MA and a slow MA. And the fast MA is the 10, and the slow is the 30. And the type is a simple moving average. Well, in the price construction, we also like to use the moving regression lines, or the least squares moving average. And there is a fast and slow pair we care about there, the RL10 and the RL30. So there is that same proportional relationship between the fast and the slow when we're talking about the relationship between the dragon, simple moving average 10, and the river, simple moving average 30. There's that relationship. And it's that same proportional relationship as you find between the regression lines. Now, it also happens that if you slice it this way, that there's a relationship between the simple moving average 10, which is the spine of the dragon, and the smoothed price, which is the RL10. That when the dragon, because it's a simple moving average, the dragon is slower to turn than the moving RL10, the smoothed price. They're both constructed on a 10-period look back, but because the moving regression line is more adaptive, has less error, if you will, it moves down first and further, and then when it reverses, you have where it enters the dragon, where it crosses the spine, and where it leaves the dragon. When it leaves the dragon, we have that RLXD. Regression line crosses the dragon. So what that represents is that after an extreme move over the last 10 periods, there has been enough retracement early to suggest that a reversal is underway, as measured by the difference in the way we construct the least squares moving average, the regression line, and the simple moving average. You'll notice that creates kind of that pocket entry. So the RLXD is like a critical state risk box entry that says, hey, I think that 10 period has turned enough that I can now maybe buy in the pocket, and then if I can get my risk out of there, I'm early in that trend turning, and now I can get my risk out, and I've locked in no lose plus dinner for two in here. And now, however far it goes, is a science project. I would love to see it take out the previous hump of the dragon. When that happens, this is no longer a pocket entry, but this is an emerging dragon. And then if you put enough of those together, you can end up seeing that lazy W, or what we would refine and call a kata 2, in which I can get this little entry. And then if this whole thing breaks out, bam, that would be great. Well, in the same way that the simple moving average 10 and the regression line moving average 10 has this important relation, in this sense, you could think of the simple moving average as the slow and the RL as the fast, the adaptive one. That same relationship occurs here between the river, the simple moving average in the middle, and the 30-period regression line. Now, we think of the 30-period regression line as the health of the trend. So when here I'm getting cluttered again, but when that RL10 moves down and then reverses and enters the dragon, crosses the dragon, that crossover, that leaving the dragon, is a really important moment, because on the 10-period look back, we have enough reason to believe that the change occurred. Now, by the same token, I'm going to draw this as a solid line, that Bollinger Band mean is, shaping the flow of the river. Now, the RL30 is slower than the RL10. So that lags. And when the RL10 and the RL30 have both moved in this direction, and then there is a RLCO, that is the regression line crossover, that is pattern P1. This little moment signifies that all of the gold that was available in this directional move, that trend is over because the fast moving average reversed and crossed the slow moving average in the form of the RLs. That's what creates the P1. That's part of the criteria that we use to build the supported spring crossing and to do the owl and so forth. Okay. Well, later on in this move, we now see the RL30 has bottomed out and reversed. And in the same way that we were now watching the relationship between the RL10 and the dragon, we can now watch the relationship between the RL30 and the SMA30 and the whole river itself. So when the RL30 bottoms out, I sort of watch for checkpoints. And that if this trend is really going to become this great trend, then what we will see is this very smooth RL30 reverse. It will enter the river. It will cross the Bollinger Band mean. That's key. And then it will leave the river. That's really key. So by the time the RL30 has crossed the river, you will have seen price already moving up. You will have seen the RL10 has left the river and is moving up. And now we have sort of three criteria for saying we have the beginning of trending behavior in the other direction. First, the first thing that has to happen is price has to be out of the river, moving up. Second, the RL10 has to be out of the river and moving up. And then the third thing is the RL30 has to have left the river. When all three, price, RL10, and RL30 have left the river, that's when we can declare the beginning of trending behavior. So a lot of times, we will have, made some trades in this transition state, and that thing is really starting to go. And it's too late. I've already missed the RLXD entry and the crossing the Bollinger Band mean and price leaving the river. It's too late. It's not too late because the higher time frames are just coming on board, and that RL30 made this great big turning movement, and when it leaves the river, that's when trending behavior begins. Everything before that is kind of noise. So when you take a look at that daily market health check on this last little swing move of the S&P about 9 or 10 days ago is when the RL30 left the river and joined price in the RL10, and then we had still another 10 bars or 10 days worth of upward price movement. So that's the relationship now between, I've described the relationship between the simple moving average 10, which is how we construct the dragon, and the 30 period simple moving average, which is how we construct the river, and then express that same relationship 10 and 30 on the regression lines, and then took a look at the simple moving average versus the regression line as the slow and the fast in this complex dance. Now I can answer the question that Denny asked me. So that price action can be a very busy place. There's a lot of things going on. And so to try to simplify that, If we take that whole discussion that I just had, and we say that's what's going on up here on the price portion of the screen, what I'm going to do is just isolate some of the larger muscle moves and simplify that as the MACD histogram. And what I'm going to do on the MACD is I'm going to construct it out of a simple moving average 10 and 30 and a 5-period exponential mover, smoother. And so when you see the MACD line go below the 0 line and falling, this is in the winter. And when it bottoms out, and so let me draw that as red because that is the color. And then it starts to roll back up. What you're really seeing is a line that is thin sliced. Every one of these is like a bar. Like if you had the MACD histogram on there, you would see that as a bar. And then as it starts rolling up, it's getting higher lows until it crosses above the 0 line. And then typically that starts getting drawn as green. You'll see that in the way we do the risk Z until it can't go up anymore, and then it comes down. So if we were to draw that edge as a line, that would be the MACD line. And so when you find that turning point, that breaks that into 4 seasons. So we would have a winter. The MACD line is below the 0 line, so we have a negative bias and the slope is falling. And then it becomes spring when it's below the 0 line, but it's rising. And then it becomes the summer when it's above the 0 line and rising. And then it's in the fall when it's above the 0 line but falling. This MACD line is a simplified, almost climactic or seasonal interpretation of what's going on in the world of price, which we just saw had all those complex things moving around. This gives you a relaxed way to think about the seasonality of price. And what it's doing is really expressing the relationship between the dragon at its little turning points and the big fat river, right? With its Bollinger Band mean in the middle. It's really looking at the relationship between, the center of the river as the midpoint of that big long trend, and the spine of the dragon, which is the middle of that 10 period. So you're really comparing the 10 simple moving average, the spine of the dragon, versus the simple 30. You're looking at the relationship now between, I should put it this way because it's vertical slice. You're looking at the relationship between how far has the middle of the dragon moved away from the middle of the river. So if price was mucking around in a nice sideways and then experienced a great big adverse move or southern move, it doesn't have to be adverse, right? What you would see is that the dragon would leave this pretty quick and head down until price started to reverse. And then the middle of the river would be here, and you'd have some kind of slower moving relationship. And so what you can see is that as long as this trend is generally continuing and the 10 period is falling faster than the 30, then this relationship is going to get wider and wider and wider and wider until price reverses, and then eventually the dragon follows suit And then the river is much slower to follow and start to adapt. And so what we're really doing is the MACD histogram is now looking at the seasonality of this space in here, the space between the simple 10 and the simple 30. Well, price doesn't always just go like this sideways and then makes huge moves. Sometimes, I mean, it will oscillate and give you different signs. So in order to understand how significant that move down was in the winter, and I love a harsh winter because that signifies there was a significant move that traders made away from the previous fair value, so that one of three things could occur, and two of them are great for us. One of them is that there was some really good reason for price to have moved that far that fast. There was some new piece of news that was really important, and that caused a rapid repricing. So now when it gets down to here and starts to hesitate, was that all there was? Did that all get processed? Or after this moment of hesitation, is there going to be another big move down? So that's good for us because that's the second leg down, and there will probably be another collapsing dragon inside there. When price, sold off and then hesitated and then collapsed, there's another collapsing dragon in there. So category 1 is great because now this winterish move, that would end up showing up as a winter, that thing could be the second leg down. And so the magnitude of this move we use to estimate the magnitude of the second move. Well, the second thing that could happen is that you say, oh, it turns out that maybe this was not so bad after all, and that this big move down was an over-exaggeration, not just an exaggeration, but an over-exaggeration. And so what's going to happen is this price is going to correct some distance. Well, how far up the stack is it going to go? I don't know. Nobody knows. But if this was really a significant move, maybe it's only a 50% retracement. But it may be that a 50% retracement is sufficiently good that if I can get this entry down here, that I can get a couple scoops just to a 50% retracement. Or it may go all the way back up to the previous fair value, and that it turns out that this bad news was false anyway, and they were just messing with us. So that's the basis of that supported spring crossing and the owl and kata 2, because if this thing starts wiggling its way back up, we might be able to do, through engineering, a way to do a series of trades that are risk managed. So that's the second thing that can. The third thing that happened is it comes out of here and it just kind of wiggles around, and they were able to discover the new fair value here. Well, if we're trying to trade, we're not going to lose a lot of money, not going to make a lot of money. And so the third thing that can happen after a really big move is 2 out of those 3 are very favorable because they give us large moves out of a critical state. And the third one's not bad because it's forming a new critical state. And then it's going to take us right back. It's going to take us right back to this condition if it stays there long enough and become a Z3P or a super pinch. And either one of those, we know how to trade them. We trade the breakdown or the breakout. So this gives you this kind of endless loop of trading. All right, so let's suppose we were using the MACD histogram now as a way to simplify the conditions of what are going on up there in the price window, but I don't want to have to, ferret that out and do a lot of computation to figure out what's going on. I can really use the MACD histogram as a heuristic to very simply assess, hey, where am I in the 4 seasons? And then depending on the style of trading I want to do, I could look across many symbols in my stack and say, hey, which ones of these are maybe, and if I just divided that into something like 4 seasons, hey, which ones are in the winter and which ones are in the spring and which ones are in the summer and which ones are in the fall. Now that it's not stacked necessarily in any logical order except kind of sequence, but what I really like to see are things that have had extreme winters, because those are driven by fear, and fear is more violent than greed, and so the chances are greater that a winter was an over exaggeration in one direction, and that the reversals could be a sharper return to fair value when people want to buy on dips. So the worse the winter, the better I like it. So one of the ways I can rapidly figure out, well, just how bad was that winter, was I can use the MACD 4 seasons and say, how far away did the RL10 get from the winter? Now, what would be even better was if the winter was falling and the dragon was falling, and the stretch of the dragon away from the river was great, then on the MACD histogram, I'm going to see the furthest possible excursion of the MACD line going down. I really want to see that. The sharpest, furthest fall. I'm going to make that bigger. So I'm going to draw this as the zero line so we can really zero in on that, if I may say it that way. So when price was just mucking around and then it makes that big sharp move down, at some point that sharp move down is bad enough that the dragon and the river are both falling down and the dragon's accelerating, and it's bad enough that it goes below the zero line. And then it goes as far as it can go and then starts to reverse. I would prefer to buy in that spring than something that only fell this far and started to reverse, because this indicates a lot of the emotion of fear had entered the room. And therefore, this might have been an exaggerated sell-off, which means that the snap back could be shorter, sharper, faster, bigger. And that's the one that I want to get so that I can get my stop to no lose plus dinner for 2. Now, I'm not executing off of this one. I'm executing off the patterns that I see up here on the price table. But all other things being equal, I want to be able to rapidly compare the difference between how bad was the winter. So the construction we put on this now is the Red River. So the river up top is the Blue River. I'd think of the Red River just to keep it separately. So the Red River idea was, I'm simply going to put statistics on that relationship. All right. I'm going to use a 30-period Bollinger Band plus or minus 1, which is essentially the river, only I'm going to put that river on the MACD line. Up top on price, or on the price window, I'm using the Bollinger Band mean 30 plus or minus 1. I'm putting that on price. Down here, I'm putting it on the MACD line. And what that will do is draw a red river looking thing that we interpret the same way, that this is the region where the normal back and forth of the river and the dragon would normally be found within the Red River. So when I see the Red River on that chart and I see a MACD line that has pulled well away from that Red River, that has the same effect as the dragon leaving the river, or the RL10 getting far away from the river and the 30 period. It signifies an extreme move away from normal. And the bigger the move away from normal, the better I like it. So on my charts on the spreadsheets, what you'll see, I have a Z-score on the 4 seasons. And all that is doing is taking a vertical slice and saying, oh, that's horrible. Sorry. So I'm taking a vertical slice and saying the middle of the Red River is going to be a Z-score of 0 because it's the average. And then this shaded portion of the Red River on MACD is going to constitute plus or minus 1 standard deviation. So there's plus 1 and minus 1. So if the MACD Z-score is minus 2, then what that tells you is it's a full 2 standard deviations, 2 full standard deviations away from the average. And that tells you that this was an extreme winter. And then on the upside, if that MACD histogram and things were great and off it goes, and it has a plus 2 on the MACD Z-score, then that tells you that that both the dragon and the river both made an extraordinary move. And so if price is starting to falter, that move was so amazing that you really need to be protecting those gains. It would be nice if it continued, but I got to really protect those gains. So I'm looking for those extreme moves on the 4 seasons, which describes the relationship between the middle of the river and the middle of the dragon, to understand this relationship. And that's part of that 10, 30, 10 and 30 slow and fast, the RLC. And it's all part of a dashboarding where I have detailed tactical information up in here where I can fine tune with precision and a micrometer under a microscope, and then a just very relaxed seasonal approach to understanding broad price movements as defined by the flow of the river. What's the river doing, with a little bit of fine tuning with the dragon? This works exceptionally well on monthly charts and weekly charts to help us pinpoint those key moments early after every great sell-off of the last 20 years. If you put that MACD histogram construction on it on a weekly chart, and you take a look at when it's a couple bars into the spring and you say, that's when I want to start my buying, you will be very happy with that insight. The weekly chart just plain dominates swing trading and position trading. It dominates. And it will get you back into a rising market after especially painful. Look, there's 2 things that are hard to do. The first one is to get out of a bull market that is collapsing and is on fire because everybody freezes. That's the hardest thing in the world to do, except if you got out, is getting back in when things are getting better, because the memory of that existential threat is right in front of your mind. You're crazy to get back in. Well, crazy like a fox, or you're just paying attention to the weather, and the sun shall rise and spring's coming. So when can I get back in? Look at the weekly charts, study the seasonality of this stuff, and then fine tune it with price. So that's what I wanted to say on that one, Denny. That's the relationship between the Red River down here with MACD and the Blue River that you see up in the price bar. Both have to do with the big, broad, fat trends. They have the same kind of purpose to help us define limits of normal, and it helps us calibrate how significant the abnormal moves are, so that when they make their turning points, we can say, is that turning point abnormal enough to warrant further attention? And we can use the MACD 4 seasons as a way to refine that understanding. Okay? All right, that's what I want to say about that. Garen, did you sneak? Yeah. Oh boy, Garen, nice one here. Let's see. Regarding XR versus PR with closing price and volatility. Yeah, I also like to use the Frogbox intraday as a position sizing block, and then a multiple of 2 to start off with the swing trade. There are some stocks that are more efficient based on current price. And so if my position size remains the same, for example, if I compare 2 extremes, Boeing and 3M, Boeing has a current Frogbox of 3.8 and needs 13 shares to $50 of risk would give you 13 shares. 3M has 56 shares to trade with $50 PR. Yeah, BA ties up more money per position than 3M, or it ties up less money than 3M. And yeah, that's correct. I like to get, in terms of efficiency of capital, what I am drawn towards for shorter term trading, when I'm trying to cycle, I want more volatility, not less, because I want to be able to make the multiples of my risk faster. And so the more volatile it is on a relative basis, the faster it should make the move that gets me my position. Yeah. So at some point, the efficiency of capital really matters. That's why I'm really drawn to mid caps like CLF. Here. So when I'm constructing my portfolio universe, that subset, so there's the set of all stocks, and then I'm going to take a sample of some things from around the different categories and use that to construct my little herd. I might have some tech over here and energy over there and finance here and commodities there and blah, blah, blah. So I've got members in each one of these. So I can then see in the broad market, it's the energy is really working. So the S&P is moving up and down a certain distance. And then as I start moving to the right, I'm getting more volatility. So I'm getting the moves faster and larger. And so then I can check XLE, the energy sector, and that's related to USO, and I could do Chevron as a large cap. But I really like Devon Energy because this is a mid cap that is very liquid, very volatile, and has a thin spread or narrow spread between bid and ask, and reliably is directionally reliable intraday and as a swing. It makes long swings on swing trades and then on intraday. So Devon Energy turns out to be a frog champion because it has all of those qualities. And it has the added advantage of being cheap. So at some point, you are risking X amount of dollars as a unit of risk, and you're dividing that into the position sizing risk in order to come up with the number of shares. And so at the end of the day, $50 of risk is $50 of risk. So if I can, all other things being equal, the lower the cost of the shares and the higher the volatility, the better I like it, because it lets me get, it's like using rocket fuel or higher grade octane. Think of it as octane. So yeah. And then this same logic chain that gets me to Devon, I can use as a way to monitor market and sector and commodity conditions that are influencing the price of Devon. So when the energy sector maybe makes a move up and then starts to slow down, but Devon is still going up. It might not be a surprise if then later Devon starts to roll over, and now I can use the indicator of the sector or the commodity to fine tune how I get a narrower stop in there. So yeah, your thinking on all that is correct. So at some point, the cost of position matters, and so when you start thinking now about options and futures, and you take these same patterns, you can express that same risk reward with great precision with options and cheaper, and the same thing with futures. The efficiency in your capital becomes better. But yeah, all of the things being equal, the way you construct your subset and the way you pick the particular targets to trade matters. That's why I like things like Cliff Natural Resources, and I love U.S. Steel because it's so cheap, and I can buy a lot of it, and it's reliably volatile. And so those two are great, and so is Alcoa in the metals space. And things like Virgin Galactic, and so on and so forth. Okay. All right, that looks like everything there. That's all the comments and questions. I'll get this published and posted. The other two are already uploaded on YouTube and posted on Patreon, and I will add those. I will add yesterday's Q&A and today's Q&A to week 2, and I will put it right underneath here when I get them both published. Yesterday's was already published, and I'll be adding that to this sector or to the section as well. So next time I'm on deck is tonight at 8. We'll be taking a look at day trade frames that the team is posting in Campfire. If that ever gets to be more than 20, I may not be able to get to all of them, but until it's 20, I can probably cover them all in one session. All right. So Sunday night, 8 Central is the next scheduled podcast. So thanks for your kind attention and your excellent questions. Oh, wait a minute. I still owe Denny a relook. One more bonus. I forgot to do I got to do a redo on last night's ATR versus ADX. So I got my wires crossed last night. So there's two indicators that I really like, because one of them is concerned with the volatility of an instrument, and another one is with the strength of trend. The strength of trend. And so for volatility, I'm going to use ATR and ATR percentage. And for strength of trend, I'm going to measure with ADX. So ATR, I'm using, ATR 14, because that's the default. And I'm using ADX 14 because that's the default. And I want to just see what the herd is looking at. So both of those are going to give you a number. Like ATR is going to tell you the ATR is $2, meaning that the average true range will vary $2. Now, that's kind of helpful, but not really when you're trying to compare multiple symbols, because a $2 variation on a $50 stock is a 4% relative volatility, and a $2 on a $10 stock is a 20% volatility. So $2 is $2, but the volatility is really different. And then when I'm looking at ATR on a time series, if I just look at ATR and I see $2 right here, and I can say, oh, that thing's volatility is constant because it was $2 some 180 days ago, or whatever it was, and today's a 0 day. When I use that look back period, oh, it's always been $2 constantly. So I guess the volatility hasn't changed. No, but if I put a price overlay on that, and if price went from $10 to $50, back here when the ATR was 2, that actually represents a 20% volatility. And up here where it's $50, it's only 4%. So if you are strictly using ATR, the number, a time series chart can actually give you a false reading. And in fact, if it was $50 and then $10 was the price and it went from 2 to 1, that would lead you to believe that volatility is declining. But $2 on 50 is 4%, and $1 on 10 is 10%. And so even though the raw number of ATR is declining, the volatility is increasing significantly. So if you're not careful, your visual cortex is going to deceive you if you're not careful. So what you want to do is, I think, use the ATR percentage. So you're taking ATR divided by price, and that will give you a percentage. And then when you do the time series as a percentage, you can actually see what the normal ebb and flow of volatility actually looks like. Well, I want to know what the difference between normal and abnormal is. So what I'm going to do is what I always do. I take 180 days of look back, and I'm going to compute the ATR percentage for each of those 180 days. And then I'm going to rack and stack that, and I'm going to find what was the maximum ATR percentage ever, and what was the minimum ATR percentage ever, and what was the average, and what was the standard deviation. And then I can construct a z-score ladder. And the z-score, that's 0, and that's 1, and that's -1. And then whatever the maximum was and whatever the minimum was. Then when I track the time series of ATR percentage, I can tell you how extreme or normal that current volatility is, and what's the direction of movement of the trend. And when it starts to reverse, how significant was that as a turning point? So in the way we always do it when we're constructing this statistical treatment, this little table, between +1, 0, and -1, because math, 1/3 of the data exists between 0 and 1, and 1/3 of the data exists between 0 and -1, or a full 2/3 of the data, and we're going to call that normal, is a z-score between 1 and -1. And of course, the time series now lets us see what directionality that's going. And then only 1/6 of the data is between 1 or higher than 1 and lower than -1. So this is what we would then describe as abnormal. Now, in terms of ATR percentage, where we're talking about volatility, the way that construction works is that whenever the ATR percentage is more than 1 standard deviation above that long-term 180-day average, then that's going to be volatile. And if it's within ±1, that's normal. And then if it's more than 1 standard deviation below average, it's going to be quiet. So that's how we use ATR percentage to construct our classifications. So in our model, of bull, sideways, and bear, and volatile, normal, and quiet. The volatile, normal, and quiet is constructed using this statistical treatment to come up with definitions of volatile, normal, and quiet. Now, one refinement. You'll see that instead of using a 180-day period look back, I have refined that to a minus 100 just for ATR because I wanted the extra sensitivity. And so the chart you see is using a 100-day. But my normal starting point is 180 days. And when I now talk about strength of trend, I'm using 180 days. But I wanted to be in full disclosure. I wanted you to see that. Okay. Oops. So the next thing that I'm interested in is ADX, because as a measure of strength of trend. So we're going to use ADX 14 as the default measurement of strength of trend. Just a moment. Denny has a. Is this where? I don't understand your question. Can you say it again, Denny? Is this? Oh yeah. Is this where you chat? Yes, correct. On the question icon. Yep. This is where you chat at, Denny. I had to put my glasses on to see the small print. So ADX is a measure of strength of trend. What it does is it compares the open and the close, and it uses something like average true range, and it's trying to find directionality. So what it does is it takes a look at today's price and says, what portion of today's price was above yesterday's high? That's good. That's positive signal. And what portion of today's price was below yesterday's low? Well, nothing. There was no price today that was below yesterday's low. So all other things being equal, this was a signal for an increasing trend. Now, if this had been a large range day and it had a combination of price above yesterday's high and price below yesterday's high, it would pick the number that was higher, and it would be that kind of a day. So in the ADX construction, you can find this like on Investopedia, it uses a 14-day look back period, and it computes a plus DI. It counts up all of the pieces of the price movements that were above yesterday's high and adds to the plus directional indicator. And then it goes back and looks at all of the things where it was below yesterday's low, and that adds to the minus DI. And then those things are integrated, and then that becomes the directional indicator, and then they take it at 14 period average, and that's the average directional indicator. So as that number goes up, it's because the strength of trend was higher. Now this is a direction neutral. The ADX gives you a measure of strength of trend, and that trend could be positive or it could be negative. So when ADX is going from 15 to 16 to 17, price action might be going up because the direction of the trend is up, but you could also get a rising ADX if the trend was strengthening to the downside. So ADX by itself doesn't tell you the direction of the trend. It simply tells you whether or not that signal is strengthening, that the strength of trend is getting larger. Now, the stronger that trend number is as measured by ADX, when you look at a chart, the easier it is to see, oh yeah, well, obviously that's going to be a bullish trend or a bearish trend, because that trend will really start to leap out at you. So in volatility, we were interested in knowing, when does this volatility become abnormal? We want to know on strength of trend, when is this strength of trend abnormally strong or abnormally weak? So let's say we had some kind of price action, that it was going up. Come on, there we go. So we had some kind of price action where it was going up and then had a dip, and we bought it, and then a dip, and then now the dips are getting deeper and the upward movement is getting smaller. So at some point in here, you could just feel, hey, we had pretty strong trends, and then the trends started getting smaller and smaller and started to reverse, and the whole thing was rolling over. So at any moment, ADX is going to have some kind of reading as the strength of trend at some point. So what I'm going to do is I'm going to go back 180 days, and I'm going to find the strongest ADX, the max, the min, the average. I'm going to compute the standard deviation, plus or minus 1. And then ADXs in this region are going to be just normal. This is sort of it's oscillate, and I put some, if this was now the ADX line, I can put those boundaries on it. I can find the average, and then plus or minus 1 standard deviation. And I can say, hey, in this whole period, it's in normal, and now this is abnormally strong trend and abnormally weak trend. In an abnormally strong trend, you'd be seeing that thing really breaking out and just all directional. And then when it's in this normal range, it's starting to oscillate. It could still be going up, but it's just starting to chop. When it gets to a abnormally weak, what you've got now is really a sideways choppiness, no directionality. That's what happens. Now what we want to know from an actionable standpoint is, what is the lower boundary of weekly trending, or what is abnormally untrending? Because what I want to do is, just like we like the spring, I like to see something that can trend very strongly, and then it's now at a point of maximum sideways chop. So when ADX reverses and starts to work back up the stack, now I can see, hey, which way is this thing breaking out? And then once it starts breaking out from some sideways chop, and it's going up the stack, and I can watch the ADX getting stronger and stronger and stronger. At what threshold are we beyond normal strength of trend, and we're getting into abnormal strength of trend? Because now, when something has trended far beyond its normal, that might even become parabolic, and now when it starts to roll over and collapse, maybe that's the one where I am really tight and strict on my exit in order to preserve the gains that I made all the way up the stack. So now I can use ADX to fine-tune my understanding of where this thing is in terms of directionality. And now if we look at the daily report, I'm trying to pull that rascal up. I'm going to call the weekend report up. That's right there. So now I'm going to go look at the ADX stat on page 10 of the daily. And So this is on page 10 of the daily. It's on page, because the daily is the last part of the weekend report, is deeper. But so the ADX stat, I started looking at 500 days. I've tuned that down to 180 because you don't have to look that far back. It normalizes pretty quickly, and it saves size. So I'm going to find the S&P. So the S&P, all right, so we're going to just thin slice this and look at the S&P. So right now the S&P has a z-score of 0.2, so it's well within its normal range. It's only 0.2 of a standard deviation above its long-term average of ADX. The average ADX of the S&P is 23.5. Its standard deviation is 7.7. So the plus or minus 1 SD envelope goes from 31 to 15. So when the S&P ADX goes below 15, it's now in the region of abnormal. Oh, I'm sorry, 16. Sorry, I'm on the wrong chart. Can't read my own chart. It's 15.8. So when it goes below 15.8, it is now officially abnormally untrending. So when it goes below 15.8 and then reverses and moves above 15.8, we can now say, where was the new trending data coming from? Was it from an increasing price or a decreasing price? Because that's going to tell you who the new leadership is. Is it bulls or bears? So on this last decline in the S&P, let me try to find that. Yeah. On this last decline in the S&P, the ADX down in this region was under 15. And then as it started to climb up the stack and break out, it got above 15. And now this thing is beginning to trend strongly. It's now above average. It's at a z-score of 0.2 with a ADX score of, if I remember, what was it, 25 point something. It's got a ADX score now of 25.3, which is 0.2 standard deviations above the long-term normal. It doesn't become abnormally strong until it gets above 31.3. So right now we're in that sweet spot of strongly trending, but not abnormally so. And it doesn't become overheated in terms of strength of trend until 31.3. 2 standard deviations would be 39. The strongest in the look back period was 49, which was a z-score of 3.4. So on a relative basis, we're in great shape with the S&P as measured by ADX in terms of, is it too late to get in? How much more room is there to the upside? There's more room to the upside because we're still right in the middle of normal with a z-score of only 0.2. In fact, now on this stack, there's only 2 symbols, XLP and XLU, that are abnormally strength of trend, and XLP just became abnormally strong by hitting a z-score of 1, and his ADX is 29.2. But that's what's different about XLP is it doesn't trend as strong as the S&P does. Its average was only 20.8, and its standard deviation was 8.1. So its little window box of normal is between 29 and 13-ish, right? So its reading of 29.2 is now fractionally above one standard deviation, so it's becoming abnormally strong. So now when I look at XLP, that strength of trend is greater than the strength of trend in the S&P on a z-score basis. And that made this little sideways choppiness a real issue, because that was sort of the limit of the strength of trend that it could experience. And it just started possibly a next leg up. But I'm concerned about that is because that previous trend was so strong, this might be it. And so I look at this and say, well, there's leg one, pause. There's leg two, pause. And then the length of consolidation was longer here than it was over here. So I'm worried that it might be diminishing and that this little breakout may not have the strength of that earlier beginning strength of trend, that early burst of energy after this reversal. That's where buyers were much more motivated. Now they're becoming complacent, or there's not as many people to buy. So there may not be as much strength into that. So ADX is a way for us to assess that. So that's that. All right, that's everything I want to cover. I'll get this published and posted, and we'll get this locked in. Take good care.